Anthony, thanks for joining us today for this finance briefing. As Wesfarmers Limited is an Australian conglomerate, Zoe, Justin and I will be touching on the diverse business operations in which the group operates in. I'm Megan and I'll start off our presentation. The difference of 87 million net profit after tax, excluding significant items between the two financial years, can be explained by having strong performances across a majority of the group's businesses, being offset by events such as challenging trading conditions and the restructuring activities in Target. Earnings per share also suffered a drop of 6.6 cents, continuing the declining trend since 2014, which will negatively impact investors' confidence. Return on equity also fell by 0.2%. Current ratio remained the same. Quick asset ratio worsened by 0.04. Debt to equity ratio worsened by 0.09, which was reflected through an increase in net debt of 894 million from FY15 and the drop of 1,832 million in shareholders' equity. Net cash flows also hit a new low of 1,233 million in FY16 from 1,893 million in FY15. However, this is explained through being mainly reflected by the higher working capital investments across the retail portfolio, as well as by the working capital improvements across the industrial businesses. Wesfarmers collectively contributed 8 million more in direct funding to community organisations, in addition to raising more funds by 1 million in FY16 in donations from customers and employees, which went to a wide range of community initiatives. Overall, the social performance of Wesfarmers saw an improvement. The profit for the year in FY15 is 2,440 million, which contributed to the total comprehensive income being 2,248 million, whilst the profit for the year in FY16 is 407 million, which contributed to the total comprehensive income being 329 million. The major cause of the difference between the two financial years is due to the drop of 2,033 million in profit in FY16. This is primarily explained by impairment expenses rising to 2,172 million in FY16, of which 1,266 million was attributable to the goodwill of the Target line, whilst in FY15, impairment expense was only 41 million through normal operations. The Target impairment was due to the current and foreseeable trading performance, outlook and individual store assets, where restructuring costs including stopping trade of slow-moving items such as luggage, toys and pet care. It was written down in Target's share of goodwill when Wesfarmers acquired Coles Group in 2007. Kura contributed to the other 850 million for impairment, as a forecast of the recovery of export coal prices in the long term was slower and more volatile. Furthermore, raw materials and inventory expenses also went up by 2,480 million in FY16. The acquisition of Homebase was most likely led to this increase. That's it from me. I'll now pass it over to my colleague Zoe.
Thank you, Megan. Hi, Anthony. What I wanted to firstly talk to you about today was how the application of the new accounting standard AASB 16 will significantly impact the assets, liabilities and profit of Wesfarmers. The former standard AASB 117 excluded from a lessee's balance sheet numerous lease assets and associated liabilities. In an effort to increase transparency and reliability of the financial statements, the new standard has been introduced in which all lease contracts are recognised in the balance sheet with a right of use asset and a corresponding payment obligation liability. This new standard will reduce pre-tax and net profits, as the amortisation and financing costs associated with the right of use asset and payment obligation liability will exceed rental payments. Exemptions to the standard relevant to Wesfarmers are leases of 12 months or less, low-value assets of $5,000 or less, or leases to explore for or use minerals, oil, and similar non-regenerative resources. Wesfarmers has a number of subsidiaries within this category of which particular lease agreements may be exempt. In application, let's say Wesfarmers had net debt of 4 billion and NPV of leases of 12 billion. Debt would therefore rise to 16 billion. Citigroup has predicted that once the new standard is implemented, Wesfarmers' total liabilities will rise from 17.8 billion to 32.7 billion. Increased debt does not only look unfavourable to many stakeholders, but it may significantly impact Wesfarmers' current debt covenants that require certain ratios, such as debt to equity, to be maintained at a certain level. Therefore, renegotiations of these covenants may need to be made if they are likely predicted to be breached. Although Wesfarmers does not need to implement the new standard before the mandatory date in 2019, ASIC has stated that it expects companies to disclose the impact of the new lease standard for financial years ending on or after December 2018. I would secondly like to discuss the measurement of Wesfarmers' property, plant and equipment. For both financial year 14-15 and 15-16, Wesfarmers has measured property, plant and equipment at cost. For instance, for the year ended 30 June 2015, buildings were valuated at $928 million from a cost of $1.06 billion, less accumulated depreciation and impairment of $133 million. For Wesfarmers, the choice between using either the cost model or the revaluation model, or a combination of both for classes of assets, must be made on an objective basis rather than an opportunistic one. That is, for instance, the choice of using the cost model should not be driven by management's desire to earn greater bonuses, but to present what they believe to be a more true and fair representation of the company's assets. True and fair referring to all information that is considered material to be included in the financial statements. A question must be raised as to whether the introduction of the revaluation model for all or some classes of property, plant and equipment assets is appropriate at Wesfarmers. This is decided by firstly examining whether, by not implementing a revaluation model, the risk of material misstatement will increase, and therefore the accounts will not be as true nor fair. The revaluation model requires estimates based on professional judgment, which is subjective and, if not accurately estimated, may throw the reliability of the accounts. Therefore, traditionally, the cost model has been considered to represent a more true and fair view, as it requires the use of fewer subjective estimates. Unless the risk of material misstatement of not implementing the revaluation model is assessed to be so great that it outweighs the costs of implementing the model accurately, then Wesfarmers should continue to use the cost model, as it can safely be considered to be true and fair. I'll now pass the baton over to Justin.
Thank you, Zoe. Lastly, I would like to touch on Wesfarmers' cash generating units. A cash generating unit, or a CGU, is defined in AASB 136 as the smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from other assets or group of assets. CGUs shall be identified consistently from period to period to adhere to the comparability characteristic unless justified. Wesfarmers CGUs are separated into retail with Coles and its subsidiaries, Kmart, Target, Officeworks. Home improvement was home improvement and office supplies consisting of Bunnings and Officeworks, but since the acquisition of Homebase in February, as touched on by Megan, it is now just home improvement with Bunnings and Homebase. Along with industrials, WIS, or Wesfarmers Industrial and Safety, consisting of three main businesses: Blackwoods Australia and New Zealand Safety Blackwoods, Workwear Group, and Coalgas. WesCEF, Wesfarmers Chemicals, Energy and Fertilizers. Chemicals including manufacturing supplying chemicals, clean heat extracting and distributing LPG, fertilizers manufacturing, importing and distributing fertilizers, and last of all, resources, consisting of the mainly 100% owned Kura and the 40% equity in Bangalore, which manufactures, produces coal and exports to Asia. As Wesfarmers is a group, much of the sales revenue is attributable to the main subsidiaries, and these CGUs are large enough to have CGUs inside themselves. However, the parent does not have to go into as detail if it were the subsidiary. Thus, Wesfarmers separates CGUs into the largest subsidiary that it owns and what we see on the annual report. This concludes this call. Thank you for joining us. Those were the topics we had time for today. Hope you found this briefing helpful, and as always, have a good day.